This episode is sponsored by Tegas. Understanding expert insights is table stakes for investors today, and there's no better option than Tegas. I've been using them for years to get up to speed on companies, and they've helped me immensely as an investor. Tegas also recently acquired both BAM SEC and Canalys, adding a super fast way to access SEC filings and earning calls via BAM SEC, and offering access to more than 4,000 fully drivable financial models with Canalys. Tegas is well on their way to building a full suite of research products that can displace the legacy terminal providers like CapIQ and FactSet. And I'd encourage you to check them out if you hadn't recently. They are moving incredibly quickly with many new features and data sets. As a bonus note, blog readers will know that I run a monthly, bi-monthly deep dive series sponsored by Tegas. In them, I go deep into industries and companies with fascinating questions using Tegas expert calls. I'd encourage you to check that out if you're interested in seeing how expert interviews can help you learn more about a company and industry. Hello and welcome to the Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, review, subscribe wherever you're listening to it. With me today, I'm happy to have on for the second time, Doug from Fabricated Knowledge. Doug, how's it going?
It's pretty good, man. I mean, it's a volatile time in markets, especially semiconductors the last 2 weeks. But other than that, pretty good, a fun time, lots of interesting things going on. So at least a lot of content and things to think about. So yeah, that's how I've been thinking about it, at least.
As a non-semiconductor expert, it feels like it has been a bloodbath in semiconductor. So interesting times might be putting it kindly, but yeah. Anyway, let me start this podcast the way I do every podcast. First, with the disclaimer to remind everyone that nothing on this podcast is investing advice. You know, that's always true, but I'll just remind everybody, as we said, semiconductors can be a very volatile and very kind of cyclical industry. So keep that in mind when you're listening to the podcast. Please do your own work, consult a financial advisor, all that type of stuff. Second way I start every podcast, a pitch for you, my guest. People can go listen to the first podcast that we did together back in June on RMBS if they want the full pitch. I'm not going to do it again because that was probably the nicest, gushiest pitch I've ever done, and it might just embarrass both of us. But I'm just thrilled to have you back. I know people loved the first podcast we did together, and I'm super excited to have you back for the second time. So anyway, second time, the stock we're going to talk about today is SiTime. SiTime, I believe is how we pronounce it.
Yeah.
The ticker there is SITM. And I'll just pause there and ask you, what is SiTime and why is it so attractive?
Okay, so SiTime is a MEMS timer company. Timing goes into every single device in all of the electronic devices in the entire world. Essentially, you have to have it. Your devices have to have a clock, so that everything can work synchronously together. So up until very recently, 2006 is when SiTime essentially got founded. 100% of timers globally was via Quartz. Quartz is the legacy incumbent technology. It's super reliable. It's been around for 100 years. SiTime is kind of this company that did one of the holy grails of semiconductor technology that everyone wanted to make happen, but the technology roadmap took quite a while to get there. So in 2006, they essentially put down a patent for this special type of packaging to create a MEMS resonator. So Quartz resonators essentially are the legacy technology, and to be clear, they're very good. And then MEMS technology is the new, and MEMS, by the way, stands for micro electrical mechanical system. So essentially think of it like a tiny mechanical system, but at a semiconductor size. And so the difference between MEMS and Quartz is Quartz essentially uses piezoelectric stuff, where essentially if you put electricity into it, it resonates at a certain frequency. MEMS, however, does something very similar, but it resonates mechanically using energy as well. And so think of it as a tiny tuning fork. When you slap a ruler and it vibrates, essentially it's vibrating consistently at a frequency that you want. So these timers are really important. They're super niche, but they're in all devices everywhere. The total addressable market is about $5 billion.
And just why do products need these timers inside of them?
Well, first and most importantly is to keep the time of day, right? So a perfect example is Garmin. Smartwatches, smartphones, everything needs to have time. And so the way time is done is there's, you can actually do it with a circuit, but that's actually very noisy and kind of has a lot of electrical problems. But so Quartz is extremely stable, and MEMS is a new technology that's becoming a lot better. So everything needs to keep track of time for your devices to work. So imagine if one device was telling device number 2 to do something, but they did it at the wrong time, and so this does it like 15 seconds late. Like, what's the point, right? Everything has to be all the instructions have to be going together at the same time, and it's called a clock, like a clock frequency. And so each of these clock cycles kind of decide what actions happen, and that's like on a CPU. But anyways, all in, everything needs a clock. Like, in order to keep track of time, in order for the semiconductor devices and electronic devices to work, everything has to be on time. So, so it kind of has a torque in that way to semiconductor devices, because semiconductors are probably the most popular device that it's used in conjunction with. But so that's the way to think about it. And Quartz is kind of like a legacy technology in that it's actually not made of silicon, versus MEMS is actually made of silicon. It's kind of close to a real semiconductor, if that makes sense. So that's kind of the difference technologically.
You and I were talking for 10 minutes before the podcast about a bunch of different stuff and moving and everything. And I got to tell you, I just love how passionate you are once you start talking about semiconductors and stuff. Your inflection picks up. Like, it's contagious how passionate you are about these things. It's just one last stupid question. And this, I'm going to say iPhone, but we'll talk Apple and iPhone later as it pertains to SiTime. So don't take anything on iPhone. But, somebody might say, oh, timing, like my iPhone, it connects to the internet for time. It doesn't need a time in there. And I would just say, you're wrong. There's obviously lots of timers in there. It needs to, but please tell me if I'm correct, incorrect, just to give everybody that's very simplified example.
Yeah, so that's true. You can obviously there's actually like this whole thing called stratum, which is like this cascading network of timing and how time is distributed across the network. But so the time gets distributed across the network, but you also have to hold the time in each and every unit. They're not constantly pinging. Think about the data for that, as well as not everything is connected to the internet all the time. So imagine so it'd be like, okay, well, now we can't take a photo if it's offline. It has to be connected to the internet. Stuff like that. Like, every aspect of your semiconductor device, whatever, has to have some kind of context of time. And so, that's like the quick example. But yeah, I think that answers the question. Yeah.
So obviously, this is a little bit more technical podcast than a lot of the podcasts I do. But we look at stocks, we invest in companies because we're trying to generate alpha. So we're going to go into lots of technicals, but let's just go high level. First question I like to ask every guest, the market is a very competitive place. You're obviously looking at this company. You think it's very attractive. We'll talk about valuation, all that reasons, but just high level, it's tough to get edge. What do you think the market is missing that you're seeing in SiTime that will lead to kind of risk adjusted alpha from investing in the company?
Okay, so we'll just say it's like variant perception, right? That's kind of like what we're trying to focus at here. So I would say SiTime in particular is probably one of the biggest poster child for like things that you don't like right now in this market environment. One, it was definitely a COVID beneficiary. There's no way to say it wasn't. And two, it's extremely high duration growth. So those two things are the things that markets hate right now. And third, there's kind of a near-term air gap because this is this semiconductor's company's first cycle essentially, and they definitely overshipped. So near-term revenue is getting absolutely hammered, and so the stock was doing wonderful until last quarter. They guided down for 50 to 35% year-over-year growth, which implies a negative Q4, and then since then, almost every incremental bit of news has been very negative. So and I think we're about to have we'll see if it's a match, but like there's a guide down coming in this company next quarter, in my opinion. And to be fair, that's happening everywhere in the semiconductor space as we talk right now. AMD guided down yesterday, right? That's one of the biggest darlings just did the guide down. Everyone everywhere is guiding down. SiTime is not going to be immune to this at all. So what I've been noticing is that, this company was essentially, it had this really rosy market grows forever. They grow penetration in this market forever. And I think they will continue to take a lot of market share. But all of a sudden, all of these near-term headwinds came at the exact same time. And this company is extremely high duration growth. Interest rates have massively exploded. And if you I actually did a very full DCF, like the old school whack, like I did the whole damn thing, and it's a high beta stock. Actually, the equity risk premium for this company is like 16% because it's a 2.5 beta risk-free, market ERP is like 5%, risk-free rate's 4%. You do the math on that. It's like, oh, your discount rate is like 16-17%. So in that, like, this is maybe like a very academic way to think about valuation, but like, obviously this matters, right? Extremely high multiple, extremely high discount rate, and extremely high equity risk premium. This is the kind of stocks that are getting hurt the worst, and it has an air gap in profitability. So all these things are making a very ugly short-term situation that, like, I think is really ugly. I feel I've been like, I did some numbers of what I think they really can earn, and I'm like teens lower than the street for 2023. I think that it's ugly, and it kind of hurts my stomach to think about buying the stock, which historically back before 2020 was like a good sign, but now obviously it's going to be hard. So I would say the biggest fear is it's dead money, right? It's not going to grow, a high multiple, COVID beneficiary, and high duration. Who wants to own that right now?
Yep. No, that's all great. And look, just to what you're saying, like the stock starts the year at $250 per share. As you and I are talking, it's 85-ish per share, right? So stock's down 65%. A lot of people, and I always hate to sell side earnings for next year versus market, but the more you do it, the more you realize. But if sell side earnings here are, I don't know what you're at. If sell side earnings 4 and you're at 350 or something, right? Like a lot of people say, oh, you can't invest in that. It's like, well, the stock's down 65%. I bet you the street, like, I bet you the people who are actually buying and selling stocks have probably pretty much adjusted too. They're going to have a big meet.
The street knows it, and management is doing their best to essentially disseminate, hey, first half of next year is going to be an air gap. No one really knows what it looks like on the other side because they're selling into distributors. My EPS number is $3.20 for next year. The street is at 4. That's pretty bad. And my EBIT is much worse. Like, I have an EPS that's better than it should be because, like, I model income interest of their cash balance, right?
They got $580 million of cash on the balance sheet, and their free cash flow possible. Again, I don't want to focus too much on like the near term earnings and everything, because this is a very sexy long term story. But I did have one question. You mentioned the air gap in earnings, right? And again, that's completely understandable given everything that's going on in the street. But there was one piece of that was kind of curious to me, right? At the start of the year, like Q4, they say, hey, 2022, we're going to grow 35%. They report Q1 and they say things are on fire. We're going to grow 50% this year. Then they report Q2 and they say, ooh, things are slowing down. We're going to go 35% this year, which, based on how good Q1 was, I think they said, I can't remember. H1 was fantastic. So based on H1, that means H2 is going to be an absolute disaster. And again, the environment's tough. Everyone else is guiding down, but it does strike me like, when you find a management team that guides up and then guides down, you do start to worry, like, do these guys really have a handle on the business?
Yeah, that's one of the things I'm really worried about. And I guess the one place I'm going to give them a pass on is this is their first cycle. I do think the CFO there is very thoughtful, but I also got to essentially they are definitely sitting at the end of the bullwhip effect. They don't really have, I'm going to guess they haven't really worked on understanding their true end market demand this cycle, whereas more mature semiconductor companies obviously are concerned about double ordering, versus their biggest problem was, how can we sell more stuff now? Because we, like in 2020, I think in 2021, they actually their whole thing was, we need to have more distributor relationships. So they've just been expanding, like essentially expanding the channel. And, it's been one of the strongest cycles. And so like, this is kind of where, I guess this is their first full cycle as a semiconductor company, and it is obviously really ugly. And they just, I guess, just like everyone else, they didn't see it coming, but they also maybe got a little ahead of it over their skis.
And then we'll talk more risks later, but I do want to just go to one risk, right? Like, obviously, revenue going from up 50 to down 35 next year, there's going to be the air gap. Like, the first thing you start thinking of with a semiconductor, like high fixed expenses and revenue swinging like that, you start worrying about the business. We've all seen semiconductors with leverage go under, right? And just to put that to bed, the company has 580 million of cash on their balance sheet. They are free cash flow positive. Maybe they won't be next year if things get bad enough, but I don't think we're talking like in the near to even medium term. I think they've got plenty of liquidity where they're not going to get like kind of cycle margin calls stopped out. Please tell me if I'm wrong, but just to put that fear to bed for anybody who's looking at that.
I don't think so. I think that's one of the reasons why this, like to be honest with you, buying SiTime is very hard. Like, I think it's not an easy stock. It hurts. It is high risk for sure. It's much smaller. They were COVID beneficiaries. You definitely worry about them over earning, and maybe this is not a reasonable way for them to grow at all in the future. But then the more you look at it, the more like some of the biggest de-risker is the $580 million of cash on the balance sheet, because that makes you, it's like, look, this thing cannot go under, right? Like there is, there's about 20,
that's famous last words, man.
Yeah, famous last words.
I can't believe you said that.
Well, okay, but I mean, if they really screw up some capital allocation, sure, but it does have a little bit of put with like $25 per share in cash, and that really helps in terms of the risk reward profile, because it's kind of like the margin of safety thing where you have a giant cash load that really does help de-risk some of the downside in theory. But one of the things that I'm really worried about is the gross margins. And I think that anyone who's paying attention to this company should be, because it makes a 67% gross margin at their peak last quarter, or 66.7 or whatever. That is like a street high. That is as good as it gets anywhere in the entire semiconductor industry. And that's a little worrying to me. I was like, how is this even possibly sustainable? I did a lot of work on unit economics here. And so I would say that about 10 to 15% of their stuff is fixed. They actually are a fabless model, which is one of the benefits of their business model versus competitors, is that they don't actually own the factories. And that's like one of the cool things about doing this as a semiconductor-based business instead of Quartz, is because they get to use TSMC. They get to use Bosch. Bosch is their MEMS fab partner, and TSMC is their semiconductor fab partner. And fabless companies are asset light because they don't own the fabs themselves. They just put in the orders. They, obviously they pay the money to the fabs and they get semiconductors in return. And then the fabless companies have to go around, turn around, sell their product on the market and try to price competitively against the market. So I think the gross margin downside and margin downside is not as bad as, say, a very fixed cost company, because they're fabless, and that really helps. That's the appeal of being a fabless company. That being said, their competitors, all their gross margins expanded, their gross margins expanded. They are very sensitive to ASP increases. And I think that the gross margin is most definitely going to come down to earth a little bit. So
Perfect. So let's take a step back, right? We started talking about how this is a company that does MEMS. They're taking share from Quartz and stuff. So I just want to put that in perspective, because I think the thing you really like about this company is you think this is a multi-year, multi-decade growth story, right? So I guess just to start, I wrote the numbers down. If you don't remember, just to start, how much of the market is MEMS versus Quartz currently, and how are the two kind of evolving over time? And yeah, I'll start there. So that's just market. That's not even SiTime. That's just the MEMS versus Quartz. How are they growing? And then we can talk about how that impacts SiTime.
So MEMS is probably I would say, this is the other thing too, is the percentage of market is a little bit debatable, but the number I kind of use is about 4 to 5% today. SiTime is 90% of, or actually I think 92% of all MEMS. Essentially, they don't have any meaningful competitors at all. So essentially, when you talk about MEMS, you talk about SiTime. They're about 4 to 5%. A few years ago, they were like 2 to 3%. And I think over the very long term, they could be something like, say, 20 to 30% of the market. And when I mean very long term, I mean 2040. Like this is, so I'm not saying like, hey, they're 20% of the market in the end of 2030, which would be really aggressive. I'm saying they continue to take share at the rate they have been over the last several years. And now this company is kind of in this like part of the S curve where they actually are starting to, so they've been unprofitable for a really long time just because the revenue base never really covered their cost. Now, all of a sudden, this company has like legitimate gross profit dollars, legitimate revenue, legitimate like earnings, and to reinvest and start to grow and really become like a mid-cycle growth company and like really chop away at the TAM. And there's just a lot of like little things that they have against Quartz, because like that's like the big story is like, how are they going to disrupt Quartz? And this is kind of where this whole thing takes, like, if you talk to people in the industry, it takes like a whole turn different, because SiTime has actually been, frankly, very promotional about their performance like promises. They essentially will tell anyone who will listen, we're 10x better in every way, shape, and form. You actually do a lot of work on it, and you're like, oh, that's some real apples to oranges. And so the Quartz guys hate it. Like, they're just liars. Like, they're comparing their highest end to our lowest end, whatever. And so, like, when you try to do some real work on it, it becomes like it's like a religious war that you have to like get your. So it's like very hard to be very objective in this space. And I've been trying to kind of parse out what makes them win. There's a few things that really MEMS has an advantage over Quartz. And so the biggest one is miniaturization. Quartz event can only be shrunk so small as a crystal, whereas MEMS is a semiconductor, it can go like another half, or maybe even like a half after that. Like, it's microscopic that we're talking about the MEMS resonator itself. It can be much smaller, and that matters for like total packages and stuff. The second thing is that it's programmable. Programmability is really interesting because Quartz, whenever you make a Quartz, you have to Quartz crystal. It takes like 3 to 6 months to grow. So it has this extremely like jerky supply chain that it takes a long time for you to grow the exact crystal, cut the crystal, and then make the design. Well, imagine if you have some kind of hiccup in that like 3 to 6 month period. That's a pain in the ass. Yep. So SiTime can literally press some buttons, change the frequency tomorrow. And so they have that ability to choose your own frequency. Quartz has a product that does this, but the ASP is just like not even comparable. And that just comes built into MEMS. So I would say MEMS has these little things on the edge, and also it's an improving technology. This is the 3rd generation of resonator, and each subsequent generation has had meaningful performance increases. And when you talk to people who work in the industry in an extremely academic sense, they're like, there is a theoretical limit to how much better MEMS can get, but we are not there yet. It will take quite a bit, and it'll take a lot of R&D, which SiTime is able to spend, but it's going to improve over the coming decades. And I feel very confident in that.
Perfect. So what you've got is a new technology that is, there's debates on how much better, but probably better than the old technology. It's improving pretty rapidly. And, I said new technology choice, but this started in 2006, right? So we're 14 years into the cycle, or 15, whatever it is, versus, I don't know when Quartz started, but Quartz has been around much longer than that.
There's actually a really cool documentary in 1942, Quartz Goes to War. Like, it's an old technology. Like, we're talking 1930s, 1920s. It is probably 100-year-old technology. So
new technology, more customizable, a little bit more flexible, all this sort of stuff. So you can see, right? We said about 4 to 5% market share currently, to, you said 20% market share by 2040 or something along those lines, right? So we're talking 4x market share over 20 years, and you can see why that's happening with all of that. But then I guess the second piece to that is, hey, it's not just 4x market share, but it's the market for semiconductors, which is growing very quickly. So you could say at 4x it's market share, but the underlying market grows, I don't know, 2x, 3x, 4x over that time. So you're talking the whole market as a whole. Go ahead.
Yeah. So that's a little debatable, because timing and semiconductors have a relationship, but Quartz tends to it grows with volume, but it doesn't grow with price. Quartz has been able, essentially has a price erosion. So let's say semiconductors in the long run has done 6 or 7%, or we'll just say 6% CAGR. I think it might be more like 5. Quartz is probably doing like 3. So, but at the same time, I do think semiconductor devices is growing quicker than it has been. So there is some kind of growth in this market. I would say the number I kind of use in my whatever big TAM, my shot at the TAM, because everyone else takes a shot at it too, is 3.7% CAGR, which is kind of a lazy, slightly above, let's say, long-term growth, but not exact, nothing to sneeze at. But that market will double, eventually. So, yeah.
Perfect. Okay, great. No, sorry, I was on mute there. That's great. So, and then I guess the other thing is, so they've got this really quickly growing market, right? We just said maybe it's 5x over the next 20 years, maybe it's 10x, but it's growing a lot. The last thing is SiTime's market share, right? So what's SiTime's market share currently? And hint, it's big. Why can they expect to kind of keep a big market share in this rapidly growing market with a pretty big addressable market?
So it's 92%. which effectively rounds up to 100%, right? They like that's their monopoly. So SiTime is actually pretty interesting to me because there was like 6 startups in MEMS trying to do this exact same thing. They survived the arms race essentially. The most successful, the second most successful startup ever is called Desera, and it was bought by Microsemi, and now that lives within Microchip, MCHP. One of the reasons why I think the threat of entrant in at least the medium term is pretty low is because the absolute size of the market is not that big. So imagine investing cumulatively like $200 million to take a 30% share of a, and 30% would just be like the most amazing entrance in a two-year period of a, we'll say, 2025, it's like $700 million. So you're just really not talking like really big numbers here in terms of like making the quick payoff. It just really is pretty hard. So cumulatively, let's say you have to spend $200 million to catch up on Microchip to then get $200 million of revenue. And that $200 million of revenue will be much less profitable than SiTime will be at that, because, as they scale larger. So it's kind of one of these things. I think the entrant comes when the market gets bigger. And right now the math really doesn't work, because if you look at the total MEMS market, I would say it's 400 million, something like that. So 25% share is 100 million. So you have to spend two times the revenue just to have a shot. And that's assuming a pretty amazing first year. So there's just a lot of hiccups. SiTime itself toiled away. Like they were founded in like 2007. And I would say the profitability started in like 2019. So it's a long road. They also were owned by a corporate who just essentially like gave them money the entire time to kind of bridge the cash burn. So someone has to seriously put up some money. And frankly, I think the down cycle is actually very nice for them. That gives them 2 years of cover probably in terms of pushing an entrance back.
What I guess I'll jump to the next thing. Like you do see a lot, especially these big tech giants with lots and lots of money, right? Apple, and again, we're going to talk Apple SiTime's history specifically because it's interesting. But Apple, Tesla, all these guys, they do like to in-house a lot of different products. And if this is something that is going to go into every one of their products, I don't think they would consider it strategic because everybody's got it. But you could see how they want to in-house it at some point. Like, why wouldn't you start seeing big companies in-house this technology? Because it doesn't seem that great. Or the counter would be, hey, maybe MEMS has a little bit of an advantage, but do the big companies just keep access to Quartz just because, hey, we don't want SiTime to get that much negotiating leverage on us?
Yeah, so I think Quartz is going to be around, right? My assumption here is that Quartz is still 70% of the market in a very long time from now. And I think in terms of the actual entrant for the in-housing, it's just much harder. So the places that Apple and companies like that have in-house are places where there's IP that's kind of readily available off the shelf. So ARM-based chips is the perfect example, right? A16 is an ARM-based chip. The Apple modem that they might make was a business they bought from Intel to then try that. There just isn't that many people. Like this is a really small niche, and essentially the entire company is based out of the Stanford MEMS department, and the Stanford MEMS department hires, SiTime just hires the Stanford MEMS department as they graduate each year. Like it's a really small niche, and I just don't think it's strategic enough. There is the list of things that Apple could outsource before the, let's say $50 million $50 million a year they spend on SiTime's business is, I would guess there's probably 40, 50 components before that. So it's just very low priority, too niche. There isn't enough like readily available IP. And it just doesn't seem like it would make sense for them to outsource this. Because that was my first problem. My first question: Apple big customers, semiconductor gets in-house. That's like always the big fear. And this one is it's just too niche. Yeah.
And as you said, I think they spent hundreds and hundreds of millions over multiple years to get here. And it's like, cool, you did all that. You got to a couple $100 million revenue base. Yes, your gross margins are nice, but at peak margins, you kind of did 60, 70 million of net income. Like anybody would love that, but that was absolute peak margins, 200 million plus to get there over 15 years. Like that just doesn't, that seems kind of moody almost, right?
Yeah, it just, and so that's actually, just so you know, this is my favorite semiconductor niche moat, if that makes sense, where it's like a lot of times you'll have a company. This happens in semi-cap a lot, where it's extremely concentrated. Actually, my favorite example is like Camtech, a company that I used to love. Actually, I'm a little short it right now, but they essentially are this company that did PCB packaging. It was just like in this extremely niche back market. No one cared about this packaging. All of a sudden, their product really mattered, and it grew like crazy. But even though it grew like crazy, we're talking like a product that grew from 100 million to like 500 million or something like that. But even then, you're like, how much would you have to invest to enter this market? 200, 300 million to be a third place competitor? Why would you do that? It just kind of, the math becomes really hard to justify any kind of competitive entrance. So the end state for semiconductors usually ends up kind of being like a 60-30-10 market. If you have a third player. And my assumption here is that it eventually does end up being a 60-30-10 market.
And that's from, again, right now they've got 90%. And then I just want to go back to one other thing, like MEMS, SiTM was kind of the first one to win MEMS. Obviously they have 90%, but correct me if I'm wrong. There were multiple other entrants here. I mean, I believe tens and tens of millions were sucked into each one, and all of them kind of flamed out. And SiTM is the only one who kind of got to scale. Obviously 90% plus they got to scale. They're kind of the only ones that made it.
And second place is actually within a very large company, Microchip, which in theory should have funding. But my understanding is that they are just like, our technology roadmap is multiple years behind. And that same math still applies to Microchip, even where they're like, we don't really think investing $100 million is for this kind of 5-year moonshot project is really worth investing $100 million in something that's very obvious with. And they have a lot of places they can invest capital very quickly all the time. And Microchip likes to acquire companies. So oftentimes they would rather spend that $500 million to acquire some niche company and roll it into their entire corporate structure. Those kind of capital decisions make so much more sense than really, because it's going to be a long road. Like whoever is going to have to do that has to like see it all the way through. And I just don't think anyone really wants to do that at this market size today.
Why was SiTM able to succeed, get to scale, get a product, get 90% market share when, again, there were lots of other entrants that you listed, a lot of other entrants. Why was SiTM the winner here?
So the thing that I think, and this is like, it's kind of hard to know because, the history is written by the victors, and I'm reading the winner's version. But the thing that they really point out to is this package technology called EpiSeal. And in particular, it was an extremely novel way to design a silicon package to isolate the resonator, because that's really important. MEMS resonators, we have tons of them, actually. I was reading some extremely academic papers about the theoretical limits of the MEMS. We have tons of MEMS resonator. We have stuff that is 100, 200 times better in terms of the current MEMS technology. But the problem is, you have to put it into a package and you have to get it to work. And when you're in the package, it has to be sealed from the outside. That's really important. And the way you seal it, you can't, the more anchors you have, makes it it's an extreme engineering problem. So it's you have to have one anchor, it has to be hermetically sealed, and it has to be a certain size, and you have to be able to manufacture it using current technology that is available to everyone. And so SiTime kind of did this all, and that's called their EpiSeal technology. And so that they have a patent on that. I don't think they have patents. I mean, I'm sure they have some patents on the actual sizing of the resonators, but the resonator shapes, that's relatively known. So having the resonator is not the problem. Having the resonator and getting it stable and isolated in a package, that is where SiTime has a legitimate patent moat. So and the company that they also have a deep partnership with essentially the best company in the world. The patent was awarded to Bosch, and the founders of SiTime. I think there's some kind of relationship agreement there, but SiTime and Bosch have a very intense relationship, and they have to be one of the largest customers there. So, yeah.
Anything else you want to talk about on this? Because I was going to switch to some other questions on customers and stuff, but anything else you want to talk about on the technology, why they won, partnership with Bosch, anything else there?
I maybe want to mention megachips really quickly, just because I think it's really interesting. So actually, one of the parts of the story of SiTime itself is that they came out of Bosch. They were funded by private equity, venture capital rather, and then megachips bought them in 2014, which was really weird, if you ask me, because megachips, giant Japanese conglomerate, kind of sleepy, bought them for $400 million. And megachips is actually really important because megachips is a cash cow. The stock went nowhere for a long time, and they just managed to reinvest it into SiTime. And I'm sure they had like no financial constraints. They were free to lose money. And then that kind of like that little safe haven, that little petri dish for like 5 years, really helped kickstart them and make it through the most painful, hardest time of SiTime's business. So that was really important in terms of like the path dependency. And now we're here. SiTime's all grown up. It only took them 15 years. So
I'm laughing. I can't find it now, but one of the articles I looked up when I was looking it up is like around the IPO, there were some snarky articles that were like, can you believe how much this tiny little company is losing? Like, can you believe this giant corporation's been funding it? But that's kind of what it took to get here. Let me switch to another question. Customers, right? Anybody who's done semiconductors, and obviously you do a heck of a lot more semiconductors than me, but customer concentration is something you want to think about. You know, some semis will be like, hey, we have a cajillion customers and nobody's over 1%. Sometimes you'll have the semis that are, hey, Apple is 90% of our portfolio here, right? So I want to ask you about customer concentration here, and then hint, we're going to dive a little bit deeper into their major customer and their relationship, their historic relationship with them.
So the big customer that really matters is Apple. And Apple is really interesting because Apple adopted them very, very, very early in their business. And so Apple was like 40% of revenue for a very long time in like 2018, 2019. And essentially, as SiTime has grown and become more mature, they've kind of grown out of the Apple crutch, if it makes sense. 40% of revenue in 2018 is like the number. Now they have tens of thousands of customers, and a lot of the customers are new to them in the last 2 years. But in particular, the thing that's really interesting is like Apple all-in on MEMS really early, actually. I was actually very surprised, and that's something that I think is really curious and something that like gives me some confidence in the long run of this company, if that makes sense, because Apple is probably the most sophisticated semiconductor design company in the world. Another big customer that we really can't parse how large they are is Tesla. Tesla is a company that also all in on MEMS. And so these companies all in on MEMS for, I presume, programmability as well as size very early, and have continued to this day to be large customers. I think that will continue. And as we talked earlier, I don't think Apple is a risk of in-housing relative to other semiconductor companies where it's a little easier to do. But now we have a lot more uses. And I think the use cases are very levered to IoT. And so that's one of the reasons why Apple is such a big customer, because the Apple AirPod is probably my favorite example of this. That product might not be able to be the size it is if it wasn't for stuff like MEMS, because Quartz has like the smallest package or something is like 1.5 millimeters by 1 on Quartz or something like that, whereas they do like 0.7 or even smaller packages. I don't have that off the top of my head, but I know that there's like a another halving of MEMS over Quartz. And so those kind of devices that are really, really small and power efficient, that's kind of where SiTime has really taken off. And so I think that kind of stuff is a perfect example of like the IoT long-term bulk.
So you said, hey, AirPods wouldn't be able to be as small if it wasn't for Quartz, or if it wasn't for MEMS, right? And then you said Quartz is 1 millimeter or 1.5 millimeters versus MEMS half as small. And I hear that, I'm like, oh, well, we're talking less than a millimeter difference. How much bigger would an AirPod be? So I don't know if you know the exact number, but like, why couldn't you do AirPods as small with Quartz? Like, it doesn't seem like a millimeter would make that much difference.
Every little bit counts, because whatever savings you get in that, you get to use it somewhere else. And like that piece of Quartz is on a package. Like, it's not just like, oh, that's it, right? It's like it's the entire thought process of, we are trying to make it smaller in every way, shape, and possible. And MEMS is really the one that has they've already offered the smallest package in the industry. And I think that in the future, they will be able to offer even smaller packages. So being reliant on the MEMS roadmap is probably better for a long-term device manufacturer for IoT, because they're like, hey, why would we do something that we know cannot shrink anymore versus we want to use something that we know might be able to shrink soon.
What do you think how big do you think the AirPods would be if we use Quartz instead of MEMS in them?
I have no idea, man. That's a really hard because like it's a PCB. Like there's like tons of little devices too, and like I wouldn't say like MEMS is like the thing that made it smaller, if that makes sense. MEMS is just one of the many things that made it smaller.
But
and so
each incremental thing builds on each other. Yeah, I was just, it
Yeah.
would have been so cool if you'd been like, look, if it wasn't
Oh,
for
yeah.
MEMS, AirPods would have
like-
to be the size of oranges or something, you know?
No, I don't think it's quite like that. If it was like that, then it'd be like, obviously, that would make me feel really comfortable. But I actually think it's really interesting because miniaturization is like it's not a new thing, actually. It's probably one of the oldest things in semiconductor history, is that if you make the semiconductor smaller, it becomes more power efficient, takes up less space. And so MEMS has that ability, whereas Quartz doesn't, because MEMS is a semiconductor, Quartz isn't. And so, and something that I may want to talk about, I feel like I don't know when to put this in, is what's
just
really,
put it in right now. You got it.
well, as I say, MEMS versus Quartz, we also talk about something that's really interesting from the MEMS side is their gross margins are on an absolute basis much better than Quartz. I think that's probably one of the most interesting parts of this entire story. Imagine having a price competitive product where there are two, and I mean, maybe MEMS tends to have a slight premium, but I think if they were to be price even, MEMS would have like, let's say, a 10 to 20% better gross margin. Not like, sorry, I guess 10,000 basis points or whatever. So 10 per 20%, not like over one. It would be like one would be a 20% gross margin, the other would be a 40% gross margin.
Yep.
So you mentioned crazy.
You mentioned in 2021, I think SiTM had a 65% ish gross margin. So you're just saying, hey, look, they would set, if you were looking at a quartz manufacturer, they'd sell for about the same price roughly, and they would have a 45% cost structure. So not only is MEMS more programmable, smaller, all this type of stuff, it's also cheaper to manufacture. And right now, SiTM is keeping that as gross margin for themselves, probably because they have 90% share and 90% share of MEMS, and there's only 5% of it. But in the future, you could see a scenario where maybe they accelerate their growth by cutting below Quartz a little bit, but having a superior product and having the same gross margins.
I think the thing that they're trying to do, and this is like my take on their strategy, which I think is like very rational, is they want to continue, like they don't want to blow it up. Why blow up your really good gross margin, gross profit dollars? But when you can incrementally improve the technology, because like right now there are still cost downs going into Quartz, or no, going into MEMS. MEMS is still improving the cost to manufacture, and that will probably continue to exist. I would say, like, I don't know when the end roadmap of that is, but like, this was invented in 2006. There's, this is maybe their first decade of them really pursuing this challenge. I think they probably have 2 or 3 more decades of improving this manufacturing process. And so if you have a price that is competitive on the current market, and you could continue to win back and forth, win share, and you can reinvest into the manufacturing to then in the future lower your cost even more, so you can make money now and make more money in the future, instead of having to do the profit nuke in the short term and then obviously recoup it in future periods, which would be like really painful for investors or frankly any company to withstand. They kind of can slowly but surely take market share while reinvesting in their product, meaning that they're going to eventually have a better and cheaper product over a long period of time. And that's like, Quartz just doesn't have that available to them. They've been doing this for 100 years. Like the technology is pretty tapped out. Yeah.
Let's go. So you mentioned Apple, largest customer. They're all in on MEMS, and that means they're basically all in on SiTM, right? But they're all in. But if I go back 2018, revenue drops year over year. I believe their Apple concentration goes from about 40% of sales to 15% of sales. And correct me if I'm misremembering, but that's related to the iPhone. So I just want to, that's a red flag question mark anybody who's investigating the story is going to have. So why don't you just relay the story in whole and then probably talk about why you don't think it applies to non-iPhone products at Apple?
Yeah, so this is actually a really good one, because that was like the first thing. That was like one of the first questions, right? Because revenue goes down in 2019 over 2018, and you're like, I thought this was a growth,
a 20% plus grower early cycle, and then you see, at a pretty good time for the industry, revenue goes from 85 to 84. Like, what the heck?
Yeah, so you're like, what the hell happened? And so actually, I had to hunt this down. At one point in time, someone so there's like this giant MRI helium leak in like a medical facility, and everyone's iOS device bricks. Every single iOS device in the entire building bricks.
You said brick, not break, just to confirm.
Yeah, bricks. Yeah, breaks. brick is essentially it completely breaks and there's like no recovering, if that makes sense. So that's kind of like slang. So they all break. Every single iOS device breaks in this building, and then someone is like, what the hell is happening? And so they do a test and they realize if you fill a bag filled with helium and you put your iPhone in it, it will break. And the reason for that was SiTime. And so SiTime obviously is like, holy shit. And iPhone is like, okay, well, they designed SiTime out for 2019. And they do that. So in order to like, I mean, it's really unlikely that you're going to be in a room filled with helium, but like, it's just one of these things where like it made some headlines, and iPhone Insider was like, how could they ship this with this clear design flaw? And so they got designed out of the iPhone, which was a big deal for them, given that Apple was 40% of their revenue. And so, fast forward a few years, if you go to the website, I believe they fixed it because they're like, it's now impervious to all small molecule gases, and that would include helium, to my understanding. So going forward, this is less of a big deal, but it seems like when they were designed back in, they did not like the volume, they went from 40 to 35% to 40% of revenue. So it's like a little dip, but it didn't quite have the like torque back. But that being said, I think that for the most part, they're still in the iPhone today. There are
okay. So I was about to ask that because my understanding was they're not in the iPhone currently. But so you're saying they get designed out, but they get designed in? Because I was kind of thinking in the back of my head, oh, maybe there's a leg up when they get fully into the iPhone or something. But you think they're already in there?
I think they're in the iPhone. No one has like a hard, like, I don't really want to put my phone in helium to test, but and maybe that isn't even the right answer, right? Because the new Epi seal is impervious to gas. So I believe they are in the iPhone. And the thing that I think is actually more interesting is that Apple is a shop that is, so they're not in Samsung, especially in the Samsung modems and like the Samsung RF part of the chain, versus Apple right now is designing their own modems to in-house a large part of something that they do for Qualcomm does. If that happens, odds of it being SiTime are pretty high. And that would be another 200 million units, which obviously would probably come in at a low ASP, but odds are that would be material for revenue. And I think that's something that's like, because I've only been talking about near-term terribleness, but there's a real chance in Q4 of next year, if they make that, if they design that in, all of a sudden they're like, oh, by the way, we just had a large smartphone win and it's going to be material to sales. So, yeah.
And even if it comes at a low average selling price, like this is a 90% market share company and you lock up like all the iPhone, like there's just no space for any competitor to come in and breathe in that type of market.
Yeah. Well, why invest in number two? Like the other thing too is, where would it be fabbed? That's something I've been thinking a lot about, is like, so the semiconductor side of it is done on TSMC. There's actually two devices in a MEMS oscillator. There's actually the MEMS, and then there's the semiconductor circuitry to compensate for the MEMS. Super technical. We don't have to talk about it, but one's done by Bosch, one's done by TSMC. I don't think there is there are a few other as large scaled companies in MEMS, like maybe say STMicro, but STMicro would have to go that same problem as well. But Bosch is the number one fab for a fabless company for MEMS in the world. And so they have the largest company as like their strategic partner. I think that's really, really good for them as well, because where else would you go? So,
just quick question. I think we've already discussed and addressed how difficult it would be for a competitor to come in and all of that. But a quick question. Sometimes with semiconductors, it can be tough to make a switch. If you want to switch from one to another, sometimes it's easy, sometimes it would be really hard. How difficult would it be? Let's say you and I managed to go and somehow start up a business next year that was at decent scale, competitive products with SiTime. How difficult would it be for Apple to switch from SiTime to our product next year?
So this is actually really interesting, because SiTime had this whole problem when they're trying to get everyone to swap from Quartz. So all the timers are on custom pack, or on standard packages, but SiTime has one smaller package that is for the IoT devices very hard to swap out of. So for example, the AirPod, the watches, probably the smartphones, it's called like CSP, chip scale packaging. That's like the smallest package that's only available through MEMS. That is probably, unless if we offer the same exact MEMS product, that's probably hard to swap away from. And so then it's like, mostly, can we, the MEMS company, the MEMS startup offer a same package. If we can, then they can in theory swap back and forth. And one of the things, but then the other maybe friction there is qualification. This might not apply as much for phones, but like when things are when you get a semiconductor device to work, you have to test each and every single part component. And then you're like, okay, this component works in this circumstance. We're good to go. Now we can put the whole package together. And so for automotive, that's actually a little bit of a moat, if that makes sense. That's actually been kind of a lot of friction for them to get adopted, especially for qualification for automotive parts. And so that would probably be one of the things that makes it hard for an entrant, is that you have to get, like, it takes a lot of time to get qualified. But interestingly enough, one of the things that they're pitching to automotive companies in particular is like, we know it's a pain to get any semiconductor device qualified. Well, if you qualify with one device with SiTime, then you can choose whatever frequency you want. My understanding is Quartz, each device is fixed, so you have to qualify each Quartz device. So let's say you have 7 different types of frequency. You could do one device, qualify it once, do 7 different frequencies, versus qualifying 7 different Quartz frequencies. And if you wanted to switch from one of the frequencies for whatever reason, there's actually a really good reason as to why, like, chip designing is complicated. That's my summary. But so let's say you want to swap for whatever reason, you'd have to then go back to your Quartz manufacturer, say, hey, we need a different frequency,
and we need to qualify it.
Yeah, we need to qualify it. And they're going to be like, okay, great, but you're going to have to give us 3 to 6 months for us to ramp up that volume, because it takes that long to grow a crystal. Versus SiTime has inventory that they can just press a button. They're like, oh, great, we can swap over tomorrow.
Stupid non-engineer question. Why would you switch frequency in something once you've already got it kind of approved, up and running?
Okay, so actually, I came into this literally 3 days ago with a perfect example. Frequencies interfere with each other. EMI, electromagnetic interference. And so if something is vibrating at the same frequency in a semiconductor, they can have interference and mess up. And also sometimes there can be resonant frequency, and like it will break parts of the semiconductor because everything is vibrating at a certain level. Tesla actually gave an example of their Dojo chip, which they kept breaking, and they figured out is because the chip frequency, so the frequency that the chip is running at is very similar to the timing frequency, and so it would just create resonance in the packages, and the packages would break. And so they're like, oh, well, that's a big mistake. So what they have to do is they're like, okay, we need to fix this. Well, in Quartz, you'd have to design the whole thing up, and so like, my understanding is in the package, like you have different frequencies for different applications. So like your radio is doing at one frequency, your networking is done at another frequency, your clock is done in a different frequency, but they're all keeping time in different like layers, if that makes sense. Because if like each of these data streams have to be running at this different frequency so that it could all be working together, but if they all ran at the same frequency, it would start to interfere. So you need different frequencies for different communication levels. Yeah, super complicated. That's my best. That's gonna be the best I got in terms of explaining.
I loved it. I'm starting to get a handle on it. Another silly question. All right, so we've talked about how SiTime is going to dominate, but how they control MEMS. It doesn't seem like a competitor can come in, right? We've also talked about how MEMS is much better than Quartz. I mean, you just gave the frequency example, which I think is very interesting. We've talked about how roughly similar price, way better gross margin for MEMS. So if SiTime really wanted to, they could kind of cut price and try to take share on price, more programmability, more custom, all this type of stuff. So if you and I were designing a product today, why would we put Quartz in over MEMS? Because clearly people are, because Quartz is still growing. MEMS isn't taking 80% of the market share by 2030, right? So why would we ever put Quartz in a product over MEMS?
So the supply chain obviously isn't there yet. Like we're talking about a market that ships like 20 billion units a year. So like you couldn't just be like, hey, could you give me 15 billion units? And then be like, oh, that's like a lot of units. We don't have that. So that kind of swap can't happen mechanically, like just because it's just too much, supply chains have inertia. But and this is something that I think that I've done a decent job at, or tried really hard to do a good job at, because the Quartz versus MEMS jihad is like extremely biased on both sides. There are many places Quartz is much better. And I think that there's a potential for the MEMS technology to improve to then be able to match Quartz in those places. But there are places that right now MEMS has a worse performance product, and SiTime themselves would say no. Like they're like, we're 10 times better in every way.
Could you give an example of a place where MEMS is worse than Quartz, and why?
Okay, so there's like there's two probably like super duper duper cheap products, right? Like the absolute cheapest product you can get that's like a Chinese device or something that's like the cheap, like, you know, $6 electronic gadget that's like borderline junk. If you're shooting on just price alone, MEMS is not quite, they don't price it that way. Maybe they could, but they don't. The other place is extremely high. It's called phase noise. And so really complicated subject that's hard to explain, but let's just put it, random noise happens in the signal for networking, and it just enters this signal over time in this frequency. There's a way to measure this. It's called jitter. And so it's like, it's RMS, which is root mean square over picosecond or something like that. The best MEMS device today that I could find is like 0.1 or 0.23 like change over picosecond. MEMS can do, or no, Quartz can do much lower than that. And so for extremely high frequency, extremely low noise products, which is mostly communications, because you do not want any noise in there at all. So like extremely high end, like 5G stuff, stuff that's like really, really sensitive to noise and multiplexing and stuff like that. Like a good example is maybe like a 400G transceiver multiplexing, where they're just doing like crazy, ridiculous noise in order for them to like transmit a signal.
Let me push back.
Has to be Quartz. Yeah.
You just gave two, not completely niche, but semi-niche examples of where Quartz is better than MEMS, right? So you gave communication and just the cheapest of cheap electronic products, like the type of headphones that I buy off Amazon all the time. And my wife says, "You've already got 4 of them." And I say, "No, I only have 1 because the other 3 have broken, and I'm sure this one will break at some point in the near future," right? So you gave 2, but what about other products? Like why are cars using Quartz instead of MEMS all the time? And obviously there's capacity constraints, but why isn't everyone just banging down their door saying, "Give us MEMS, give us MEMS, give us MEMS"? It's so much better than Quartz.
The noise is another example. So like the Ethernet stuff within the car. But another example that I've been given a lot is inertia, is the fact that Quartz is very well understood. When you're designing a chip and like, you're an engineer, you've been doing this for 30 years, man, why are you going to do something new? Can you explain? Like every bug that's ever happened to Quartz has already been fixed. So MEMS still is immature in that way. So
you've already talked about how there's this market share taking tailwind over time for MEMS. And one of the other things that will probably be driving market tailwinds is like, hey, your 60-year-old engineer is retiring. He's getting replaced by a 25-year-old grad student. And the 25-year-old grad student, he doesn't have that legacy background of doing everything on Quartz. He might just say, "Oh, MEMS is superior. I will learn how to do everything I design on MEMS."
And honestly, that's one of the reasons. That's probably realistically the reason why they grow a lot of penetration. Like my favorite example is like Tesla and Apple are kind of the newer kids on the block in the like the big semiconductor picture, right? And they all in on MEMS. Like Tesla's like one of the newest kids on the block.
Actually. That was the most bullish thing you said, like right at the front when you said Apple and Tesla all in on MEMS, and your product mentioned several. You're right, it mentioned several times Apple all in on MEMS. I was like, that's the best validation I think you can give to a product that it's probably going to take a lot of share over time. They all in early.
Yeah, they all in super early. And you're like, why? And so there's like, I don't know like what that design choice was, but it clearly was like a long-term decision. And if you talk like the Tesla AI, like the AI day where they talked about their Dojo chip, the MEMS broke, and you'd be like, well, does that mean they're going to switch back to Quartz? And they're like, no, our solution is we just have a better MEMS resonator. And I was like, okay, like that's great. Like I thought that was really interesting. And so, but at the same time, like I'm just like, these industry shifts take a really long time. There is definitely a world where that rate of adoption really starts to accelerate randomly. I don't know when or how that happens. Like that's completely out of the purview of like my forecasting horizon. But I do think that there's just a lot of ways to win over the very long term, because right now I would say the product is good enough. Like it isn't there. Quartz is high-end Quartz is better in a lot of ways in terms of like performance, stability. Like it's just a more like mature product. They figured out how to do this like 10 years ago. But you know, the catch up has been really intense. And the other thing too is like so I talked a little bit in my super long piece on like the low end versus the high end. The high end, they're actually not competing in performance alone. They're actually kind of trying to do the 80-20 strategy of like, we have 90% of the performance, but we have a 40% discount. And so they kind of are like attacking from below. And then on the low end, they're actually attacking from above, where I think it's really interesting. It seems like they have like 3 or 4 out of 5 attributes. They'll be better than Quartz, and then they'll have like a 20% pricing premium, meaning the only attribute they're worse than Quartz is price. So they're beating them out in performance on like the low end time of day, which is like, just to keep the time. And then like the stuff that's being used for communications, networking, and stuff like that, what they're doing there is they're like, we're trying to have a product that is very comparable. Like for the most part, it's probably good enough, and it's like price competitive, and it's programmable. And like, so they have like, and it's smaller. So they have like all these other ways that they can kind of like shade in around. And we presume whenever they make their 4th or 5th generation resonator, then all of a sudden they'll be like, and now we have absolutely better performance.
When do you think the next generation comes out?
That's something I don't know.
Let me just
I'm going to guess it's going to be like 5. It's going to take a few years. So
let me switch to just a couple of quick valuation questions. Look, 70% drawdown roughly year state. Year to date. That's going to get a lot of people just looking and saying, oh, I wanted a semiconductor with some beta. It's down a lot. Like, that seems pretty interesting. We already talked about how bankruptcy it is not a risk here on like some levered semiconductor. So a lot of people say that, but then a lot of people would probably look at it and say, oh, well, this is kind of like 25-ish times free cash flow. Yes, Doug makes a nice story about growth, but 25 times free cash flow for a cyclical business with it doesn't look screaming cheap, right? It's 25 times this year, next year, which we don't even know. It sounds like numbers are coming down, right? So it might actually be you're paying 40 times forward. It doesn't look crazy cheap. Like, what would you say to someone who pushed back on that? How do you look at what the valuation should be here?
So this is the hard part. And I would say my biggest, I have a risk section of my write-up, and my biggest risk is trough numbers are actually could go much lower than it is today. Like, I don't know when that number is, like what that number is. Like, I think something that's really important for a name like this is like, it's a long-term story. There's a real chance, like a very real chance I'm early to this. And that's like probably the biggest thing I fear, if that makes sense. The things that I've done to maybe de-risk that is, I would say my base case of numbers is like much more realistic. And I have them more at like 30 times free cash flow for 2023. So it's expensive. That's my problem.
Let's put aside 2023, because one thing that we can definitely get caught up on is the free cash flow number for next year and everything. And it does matter. But if you start from then and work backwards, like what really matters is, hey, what is kind of the mid-cycle sustainable earnings? And then we talk about the growth from there and stuff. So let's ignore the next 12 months where there's an air gap, and the past 12 months where, everything was, what's the, on kind of 2 years out, if we just said, hey, this is middle of the cycle. We're not at absolute everything rushing through capacity. We're not at, hey, everybody's canceling every order. What's a 2 year out mid-cycle free cash flow number look like for this company?
So I would say 80% free cash flow conversion, and I would say it's like $5.50 per share in EPS, something like that. That's kind of what I'm thinking in terms of, I think that like the problem is I don't know. Actually, the other thing that I have a little problem with is I think my out year numbers for like the recovery is actually is not steep enough. So let's say like $5.50, $6 per share of earnings. That's kind of what I think is the number.
$5.50 to $6 of earnings. As we said, this is about an $85 stock. Today we're recording Friday, October 7th. The market was down quite a bit, and it seemed like SiTime every moment another dollar down. So by the time we're done with this podcast, maybe it'll be $75. Who knows? But $85. So we're talking 15x, or maybe even a little cheaper than that, your normalized 2 year out number. That's pretty good for a company that you think, again, over the cycle should be a double digit grower. Free cash flow levers a little bit better than that. Am I kind of thinking about that correctly?
I think that's the right way to think about it. And I think that like something that I keep trying to, because like I feel like I've done a lot of work about framing the long term really well, and I've like absolutely just murdered the crap out of the near term numbers to be like, how painful can this be? And like I feel really good about the numbers that I have for the next year. I think that I'm a little mean on gross margins, probably meaner than I should be. I feel like I'm a little mean on like the snapback. I really don't have them snap back quickly. I kind of assume a tepid out cycle, like 20% revenue growth for 2024. I think that there's a lot of things that like I've the entire write-up, I've tried to bake in a lot of conservatism through trying to like my entire job has been trying to frame how bad it could be, and I haven't put like an ounce of thought of the good things that can happen. Frankly, like there's a lot of things that can happen that make it a lot better. The thing that I think is really interesting and like is probably one of the reasons why I think it will persist over a long term. And so this is, I guess, the Tegas, the sponsor Tegas shout out call.
This podcast is sponsored by Tegas too.
I know.
You go ahead and call out the sponsors whenever you want.
The post. So essentially, I did some Tegas calls on this, and the thing that I thought was really interesting is a former sales manager and a current distributor of their products was like, I've never known anyone to swap from Quartz to MEMS and back to Quartz. Maybe the super low end products, but most people keep MEMS to some degree, like maybe as a second source, but it's like they just do not swap away. And so what's happened in 2022 and 2020, so there's actually this huge story is actually they were a huge kind of a beneficiary because there was a fire for like this huge part of for timer ICs, and so created this huge supply shortage, and they were essentially the only one there to pick it up. So everyone rushed to design them in. And so now they have like literally, they've probably been introduced to more customers in 2020 and 2021 than they have in cumulatively as a company. And so now they have all these design wins that they've been built into, maybe dual sourced into. And we have like qualitative understanding that customers tend to like, and they're sticky with them mostly because of the supply chain programmability. It's like, hey, you can't run out of one random Quartz device that's running at one frequency because they can just press some buttons and boom, now you have all the 40 megahertz devices you want. That's like the supply chain advantage that they keep talking about that I think is interesting. And then the second advantage is programmability. You just have so much more flexibility whenever you're qualifying, building these designs. It's a real, it's more like a semiconductor than it is like this passive device that Quartz is. So this is kind of like the thing that I think is really interesting because take a big old step back, like think about S-curve penetrations, right?
Yep.
Like it is a classic like 2 to 5% super early adopters. Like we are early adopter curve, and then we have this event where this early adoptive technology got introduced to tens of thousands of customers because of the supply constraint issue, and we know that the customers don't tend to design them out. I think there's a real chance that like S curves don't like look as linear as I project it to be, right? Like when things go to 30%, they don't just they don't just like linearly happen at 100 bips a year of share gain. What happens is there tends to be a freaking like a penetration curve where
it goes
like
2, 4, 6, and you're like 2% a year, and then it's 9. You're like, oh, that's interesting. 12. 15, 30, 70, boom, done.
Yeah. I don't think I have not baked that into the number. Like that is not even a consideration at all. And that is a possibility. Yeah.
Again, you've got Apple and Tesla all in. As you said, nobody switches back to Quartz. Like those are pretty powerful signals here. Okay, last question, and then I think we've run long. I love talking to you about this stuff. Last question. So we talked valuation, we talked about that. The last thing that jumps out at me, and I have to ask, because I love share buybacks, right? But you've got a company here, as we're talking, 1.8 billion market cap, right? Almost $600 million in cash on their balance sheet. They are free cash flow positive. So yes, they are cyclical, but they are free cash flow positive. A third of their balance sheet a third of their enterprise value is in cash, and they're not buying back shares. And then I would add on top of that, I mean, congrats to them. They did a nice job. But, the second thing I look at in anything that's not buying back shares is I go look at the insider transactions. And when I look at the insider transactions, every insider all year, sell. Now, a lot of them are 3-digit prices that start with a 2. And again, the stock is now at 80, 85. So they were getting great sells. But as recently as last month, I see here's some officer who's selling a decent sluggish stock at under $100 per share. So, like I see lots of insiders selling. I see no buybacks, no insider buying. I say, hey, what is Doug seeing here that maybe the insiders aren't, that they don't see enough value to buy shares either with the company's cash or their own cash?
Yeah. So on one, the buyback question, we'll do the buyback versus the insiders first. The buyback question, I think it's really interesting actually, because whenever they first were floated, they were 50%. So this is like a float problem. The CFO, I actually kind of like the way he frames this. He's like, we don't. Well, they ask about buybacks, and they would say we don't want to buy back because we don't want to ruin our float. Our float is already.
It's the toughest answer. I've got so many companies that tell it, and I know, and they're probably right, but it's just like, hey, your stock's cheap. There's nothing you can do better than buy back shares.
Yeah, I think I don't think it's quite to the level where it's like, okay, this is just like the best cash on cash IRR they can get. I think that they do probably. I think what would be really interesting is actually if they bought another MEMS company, because they are kind of they do have a big socket, and they like that cash is going to be used. I would frankly like to see a buyback as well, or frankly, I would like to see them buy back the Megachips stake because it's still 25% of the company.
Yep, 5 million shares. Yeah, it's a big slug.
Yeah, so it's like they could maybe take some of that off. Like that would be really interesting to me. I don't know. They have this big war chest. What are they going to use it on? I know they want to do some M&A. They want to buy some like IP on the side. That is something I feel pretty confident that they're thinking about and looking at. And then like the buyback thing, they're maybe a little worried about float. I think that maybe they should just do something like I don't know, maybe like a dividend. Like that would be crazy to me, like 1 cent a share or something. But it's like, hey, like it's something, because I would like to see it, like them to talk about it. I think that is like optionality that could be really good, but also your biggest fear is that they're going to piss it away in something really stupid. That is probably another huge risk that I'm like very concerned about, because that's like right now the big put on the stock is, hey, $25 of cash a share, but you're also like, what are they going to use it for? I don't know. I would love for them to answer that. I think that would give a lot of confidence for shareholders in the longer term. The other thing, the other question on the insiders thing, I think that one's really interesting because I've actually looked a lot at the granting history. They had like this really hyper aggressive grant in the beginning of this year, like with PSUs on price hurdle stuff. I think they've been a little burned. They've been giving themselves a lot of shares along the way, like a lot of shares along the way. So I think them getting a little lighter, I'm not really going to chastise them. And insiders for the longest time have thought their shares were expensive, to be clear. Like I followed this company for a technology perspective for a very long time. Like one of my friends who's a really interesting semiconductor technologist was like, hey, you should really check out this company. And I looked at the shares, I'm like 150 times earnings. Hell no. Like I'll read the earnings calls. I'll keep up with it. And they did giant equity offerings all along the way. They did. And those equity offerings obviously ended up being super awesome because they have now $580 million a share of cash on the balance sheet. But I think that insider selling, it continues. Some of these might be 1041B plans. Yeah, some of these are 10B51 plans. So they are like automated and continuous selling. That's where you're seeing most of the continuous selling from the insiders.
I hear you. And look, everybody's got their own thing, but at the same time, if they thought it was cheap enough, you can cancel your 10B51 at any time if you want, right? So they could cancel.
And there's they could do prices too, where it's like under this price, you don't sell. I think the rate of selling at least has slowed the hell down from the beginning of this year. Like, if you're looking at like the beginning, when there was a 2 in front of the triple digit stock, there was significant insider selling the entire time. That pace has kind of slowed down, especially since we've gone to 130, 100, whatever. The last insider sale I see is there's one guy selling a nice little like 150,000 at 97, but the insider selling as like a rate of change has really slowed down. I would love to see some insider buying, truly.
Yeah, I'm with you.
What I would like to see.
It's just, sometimes you have this with companies, right? Where they're really good at capital allocation and they issue a bunch of shares when their stock is dear, right? So the stock's at 1,000 and they issue a ton of shares and all the insiders are just hammering the sell. And then the stock comes down to 500 and they stop selling and they don't buy back shares. And you're kind of like, hey, like these guys are good and they've got a lot of cash on their balance sheet, but they're not buying back shares. They sold a ton. They're not buying back. They sold a ton for their personal accounts and they're not insider buying. And you're like, maybe they just kind of think it's fairly valued at this point. Like, and if they think it's fairly valued, I should probably think it's fairly valued. And I should wait till they give me the, like, we are greedy, we're buying back shares. Cause the insider ownership's okay. But the CEO, he made $11 million in 2021, 10 million of it was stock. So he should be incentivized, but it was stock issued at 200. So anyway, Doug, I think we've run super, super long. I've really enjoyed having you on this podcast. I'm super excited that you're doing the Tegas deep dive thing. I believe we're taping this October 7th. I believe you're going to post it publicly kind of alongside when this public podcast comes out. So we'll link back and forth so everyone can see it. But Doug, Thank you so much for coming on. Have a great weekend. And I'm looking forward to time number 3.
Yeah. Thanks for having me, man. Appreciate it. Till next time,
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.